This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. Welcome, everyone. This is something new that we're trying. We're hoping to have a weekly macro podcast, title TBD, I think. I'm Tim Graff in London. I am joined by my colleague, Mr. Risk. Fred, how are you?
I am well, thank you. Good to be here.
Excellent. Yeah, good to be doing this. I think if this goes well today, maybe we'll post it, but this is kind of a practice run. Don't adjust your headphones. What you just heard was the opening from the very first episode of this podcast back in July 2019. 4 years before it was called Street Signals and available to the public, and obviously well before I got a decent sounding microphone and editing software. The podcast got its start as a WebEx chat between myself and this week's guest, Fred Goodwin, Mr. Risk. It's obviously evolved a lot while doing it almost every week for the last nearly 7 years. But I remember even back then in 2019, I had an idea to do an in-depth interview with Fred, not talking about macro stuff, but talking about his career, his experiences trading, and how he's built his unique mindset in looking at markets over a 40-plus year career. And with news that he's not far off from retirement, the time to do that interview is now. But this isn't just a trip down memory lane, at least not entirely. We do cover some very timely questions of market valuation and what to make of the Japanese yen this week. How you doing?
Yeah, no, I seem to be getting better.
That's
One of
good.
my relatives had a theory about what was wrong with me.
I have a few theories.
So anyway, I don't know. I feel pretty good right now, so I'm just going to try and do what I can this week.
Very good. Well, I appreciate you doing this, squeezing it in.
Hey, no, I'm happy to do it. I think it started with you and I, didn't it?
It did. We're going to come back to that. We have, as a bonus for our listeners, clips from the very first episode of Street Speak, back when it was called that. It was a Fred and Tim production. But one of the episodes I had an idea to do back then was to just talk to you about your career. At that point, you'd been working in markets as long as you have, minus 7 years or so, 6.5 years. So we're going to do that as a sort of parting shot, as it were. So, Fred, why don't you talk about how you got into this business? You've done a lot of different things. Let's start at the beginning, though. Where did the Mr. Risk origin story begin?
Yeah, no, so that's really interesting you're asking that. So back when I was at Davis College, I had a friend of mine who met a guy over the summer when he was a freshman, and he decided he wouldn't come back to Davidson, that he would go to Chicago and try to become a commodities trader. And so we started trading on an account together, and we made quite a bit of money in it. And then so at the time that I graduated, unemployment was like scary high, and there were no job prospects. So this is 1980. I'm just looking at it now. Unemployment was on its way to 10.8%. So I thought, what the heck? This guy's done well. I'll go to Chicago and see if I can also become a trader. So that's kind of how I got involved. At the time, I didn't have, I was pretty undercapitalized. I gave it a try as a local, but then I ended up sort of hooking up with Bank of America on the floor. And then later, they offered me a job to trade FX options in New York. So that's kind of how it all began.
In the pits, what were you trading just as a local or trying to be a local? What was your first market?
There was a yen. I traded yen.
Okay.
And then once the S&Ps opened, I tried to trade the S&Ps, but being undercapitalized, that was pretty poor idea, to be honest with you. And so, I tried that. I will tell you one funny story, though. When I was actually a clerk and they didn't want us to go off the floor except to use the toilet, there was a popular diet at the time called the Pritikin diet, and my friends really chided me because I was caught and fined for eating a raw potato on the floor. That was quite hilarious.
This was the
They
80s,
never
though.
let me
Surely,
forget that.
Surely there were all sorts of food bets that would be going on that would be acceptable.
Probably. Anyway,
Did you
that's for some reason 40 years later that sticks in my head.
did you work with anybody there who people will have heard of? I mean, I know a lot of the big hedge fund names came from the pits in New York, but Chicago has its own fair share of well-known traders that have come out of the pits. Did you work with anybody we'd know?
I don't think so. Most of these
No.
guys were independent traders, and then after it went electronic, they tried to do it off the floor. It didn't really work out for a lot of them because the skill levels were different from being able to do that. None of the names that I know would
Yeah.
sort of resonate with anyone.
Right, right. That was your start. You moved to FX options trading at B of A, you said. And
Hmm.
did you stay in that for long? And actually that's an interesting one because I'm of course starting to focus more again, refocus I should say, on FX options as part of my job. I mean, what was that market like then? How developed was it and how long did you work in that?
Oh, yeah. So I was actually right at the beginning, and I think a lot of people don't know this about the FX option market. There was an initial start which blew up spectacularly, and then it restarted. And so I was more or less part of that restart. So the original one was basically a couple banks, Bank America being one. I can't remember the other one, probably was Citi. I'm not sure though. And it developed because of South Africa. South Africa wanted a way to take out some insurance against a currency collapse. So ironically enough, the very first FX options were in South African rand, and Bank America spectacularly blew up, and so did the other bank, whoever that was. And then they restarted it, and I was part of that. When it began, I was on the floor of the exchange, and then later I was in Bank America New York, and the spreads were about 1.5 falls wide, and you were trading, 5 million or 10 million was the size. And then, you know, as it evolved and it morphed into kind of what it is now, where, you were doing deals of 250 to 500 and spreads were 2 or 3 tenths wide. I feel like for a long time, it didn't really change. That was kind of the norm from, the early 90s for a long time. Of course, now it's all different. It's all electronic. It's all algorithmic, I'm sure. I'm sort of out of touch with what the latest technology is in this space. But yeah, it was really a fun time, to be honest, to be in that business from the very beginning.
I've been surprised in looking at it kind of for the first time in depth for 12 or 13 years how little has changed. I mean, I think regulations probably have a lot to do with that. The stuff that was traded prior to the financial crisis, nobody has the balance sheet to warehouse that type of risk anymore or take proprietary risk around it. I could be wrong on that.
Before we move off of this topic, Tim,
Yeah.
I want to tell you a funny anecdote. So
Yeah.
I was part of First Chicago, which was a joint venture with O'Connor. I want to say the early 90s or late 80s. I can't remember exactly when I was there. But anyway, one of the funniest things that would happen is we had a 24-hour desk out of Chicago, and I worked the Tokyo shift. So I'd come in at 4 in the afternoon, and I'd work till 12 or 1, and I'd hand it over to the guys that would trade Europe. But there was this thing back then, you probably heard about it, where the Japanese banks, all they did is sell. They'd come in, they'd wanted a bid for 500 million of 1 month, at the money yen options. The whole idea was to take in as much premium as possible. So what would happen is that the yen market would get driven down in vol terms to these like unrealistically low levels in the Tokyo shift, and then it would get bought back in the European and US shifts. So it was really a weird thing where we would kind of inventory volatility in these huge amounts out of Tokyo. And then by the end of the day, we used to call it TM, so trademark. It would all come back, and we'd have a pretty decent profit by the end of the day. So I just thought I'd throw in that weird
Nice.
anecdote.
Nice how that works. Yeah, it's interesting. How long did you work as a trader then?
I was about 10 years worth,
Okay.
so, until around 92, 93 when I moved to
Yeah.
London,
Yeah.
and then I was involved in the interest rate option market.
Okay. But you worked in sales for a little bit as well, didn't you?
That's what happened when I
Okay.
moved to London. I worked
Right.
in sales. I worked for Cantor Fitzgerald
Okay.
and ran their interest rate option desk there, and then later I went to Swiss Bank on the sales side. Yeah, I worked for a while at ICAP,
Yep.
and that's where I actually developed what is became known as Prop Shop and now Mr. Risk. It really began as a strategy piece from ICAP that was sent out to the swap and swaption traders that ICAP had. So that's the origin of that piece.
Okay,
And
so now
then
we are getting to the origin of Mr. Risk here. Was that the sort of, because you've historically been at least working for us, and I think prior to that with other institutions, famously or perhaps notoriously contrarian. Is that where that streak started?
I think the contrarian nature that I have are informed by my experience
Yeah.
in a way that maybe people who are younger to the market haven't had. You'll have to remember that I was trading FX options during the 1987 crash. I was at ICAP when everyone on the desk was speculating in stock. It was crazy. People were unconstrained in terms of what they were doing with their PA portfolio, and that's the only thing anyone talked about. So I think my contrarian nature has been reinforced by the '87 crash and again the dot-com crash, and so I've become very, very skeptical of extended mania style moves. It definitely isn't always a benefit because it makes me too skeptical when I shouldn't be, but I suppose it does keep me out of blowups when they do happen.
I'm only getting over a bias to avoid risk that was built in response to the dot-com blow up, where I took what little money I had and just tried to buy what looked like a cheap, well, it was Oracle, in fact, which I probably should have held on to. Because that experience colored the way I invested for years, do you think that it colors the way you personally allocate money?
I absolutely do, but I think there's actually another factor that I think is worth discussing. It's how different things over my long career that I've looked at and ranked as important have changed through time. So there was a time when the most important thing in the early '80s was the money supply. Then it became the trade deficit. Then it became the unemployment number or ISM. It's all these kinds of different things that the market has focused in on as the most important thing. What I think is one of the most dangerous developments that we have in the markets today is how in the past, people would have had a broad range of reasons for entering a trade and conviction around that trade. And what I think is really troubling is that you've had this, I suppose, light bulb moment that's gone off for so many people that it's only become a single factor model in the sense that what is most important to people is momentum, whether it's price or flow momentum. And of course, State Street has right been at the center of that and has really benefited from that. But if you think back to just after the dot-com crash, probably about 2% of the market was passive. And officially, it's more than 50, but unofficially, you could say 75 or 80 because there's a lot of funds that don't dare stray too much from a passive allocation. And, as my former colleague Indigo Fraser Jenkins once said, it's become very, very Marxist. So you allocate money not on anything to do with the fundamentals of that company, but based off of the size that it is in the index. And I find this could be extremely dangerous when you have a single reason for why trades are being done. I think it's great that it's worked, but it's to me like a systemic risk index idea where when you have a broad range of factors, the first three factors explain a smaller amount of variance. But when a single factor explains almost all the variance, the fragility of the market is much higher. And that's kind of where I think we are right now. As it's going fine right now, momentum is working, whether it's flow or price, but I just think markets are incredibly dangerous.
There's a counter to it that has said that the move to passive that you describe is a realization on the part, especially of retail, that they cannot beat the market. So why not index? I don't think that's really a disagreeable point. The question then is, if this is a risk to be wary of, what unravels it? Where do people ultimately find their point of pain when, for the last, especially certainly the last 5 years, every dip is bought because I think, to your point, you had just passive flow coming in at regular intervals. And you just have that persistent belief that I cannot beat the market. So I'm going to index and let the market do the work for me. What unravels that, I guess?
Yeah, no, that's a really good point. The first thing I would say is retail has definitely become a huge factor in the market. I'm going to guess that it was something around 5% of the market and is now up to like 25 or 30% of the market. So it's become a huge, huge factor driving the market. There's no question about that. And of course, a lot of energy is put trying to identify what retail is doing. And so that's one particular issue. I think in terms of the passive, the couple things to keep your eye on are if you do have a softening labor market, the 401k flows potentially will slow as less people are employed. So that's one thing. The second one to look out for is the boomer generation as we start taking distributions. I'm a boomer, as you know. That will be important because the 401ks having all this firepower, they'll have less. Maybe it'll even at some point turn to outright outflows, which will just kind of reverse what we've seen. So the biggest stocks will get hit the hardest. The third thing I would say is you can't talk about this without wondering if is there any relation to what's going on in terms of AI. I mean, AI sounds amazing. We talk about whether it's in the fifth, sixth, seventh, eighth, or ninth inning. We don't know, but history would say that whenever we have these kind of innovation waves, markets tend to over extrapolate and there is a substantial correction. And the final thing I would say is that when the correction comes, it's going to be absolutely brutal because so much concentration in a few stocks that are leveraged off the AI theme means that the downside when it comes is liable to be pretty intense.
I mean, that's clearly a strand of contrarian thinking. I wanted to circle back to your nature as a strategist, as a thinker, as someone who's been in markets for a long time. Do you think it's become easier or more difficult to be a contrarian insofar as you have everyone who thinks they're a little bit, oh, I have a little bit of a contrarian streak to me? It's like, hmm, if everybody's saying that, they really probably aren't. But I think everybody does try to be. So do you find it easier to stand out with a view such as what you've just given? Or do you think it's harder because there are more contrarian voices out there, or supposedly more contrarian voices out there?
Here's what I will say. I think it's quite easy to identify market bottoms. I have a very small set of tools that I've relied upon consistently to do that. One of the ones that's worked quite well is if you look at the VIX first fourth contract, when that spread goes to 5, your bottom is close. Tops are extremely hard to get the timing right on. You can be looking for a top for, you know, 6, 12, 18 months and nothing can happen. So I definitely think it is extremely hard to get the timing right on tops. The thing that keeps me bearish, and I don't know how many people think about this, is the point I touched on earlier. I think the fragility in markets is much higher now than it has been in the past, but maybe it's not identified as such. The reason I think that is I think central banks have exchanged near-term stability for longer-term fragility, and it hasn't actually manifested itself yet, but that's one of the things I worry about. And I guess finally, I'm pretty old school in terms of looking at valuation, whether it's credit spreads or equity long-term valuations. I mean, they've been elevated for the last couple years. They've become more elevated through time. And I guess, I pay more attention to those things and worry about those things more.
We're going to talk a bit more about current markets. I think one of my questions on the consensus risk you're happiest to challenge is close to being answered, but I'll give you a few minutes to think of some more. Before we do that, in a long career, as you say, dating back more than 40 years now, I wanted to get your best call and your worst call. So let's start with the best call that you've made, whether, it could be as a trader, money you made, or as a strategist, a view you had, and then let's talk about the worst one.
Absolutely. So the best calls, I say they're a kind of a range of going back to my method for calling bottoms. I've done it many, many times in March of '09,
Yeah.
also in the recent or not so recent, but in the bottom of March 2020, and then again just last April,
Mm.
I identified based off of my VIX indicator and other indicators that there was a bottom. So I not to pat myself on the head too much, but I have been pretty good at calling bottoms. Where I suck, if that's a technical term,
Yeah, yeah, we
where
can
I
keep that in,
suck,
I think.
where I suck is like calling tops. Really terrible at that. And, I've kind of been negative for a while, but I will tell you my worst call of all time,
Yes.
and it's self-effacing for sure. In August of 2008, there had been quite a sell-off. I thought maybe the market was going to stabilize. There may have been some wishful thinking on my part because I was working for Lehman Brothers and things weren't looking good then. And I thought that there was a bailout coming for Lehman, and that would put a bottom under the mortgage market. It was, in retrospect, never going to happen. It was just too big a problem.
Yeah.
And so I was spectacularly wrong on my own firm. And soon I lost my job, as we all know. So that was bad.
Well, the blessing in disguise, though, Fred, is it led you to us, I think. So every cloud. Well, and that actually takes us nicely to the first couple episodes of this podcast that I wanted to talk about, because, of course, I think it was the first 5 or 6 before I was sort of encouraged to branch out. And there were a couple of topics we talked about. And actually, this is a really advantageous time to revisit them because some of those topics are still very much in play. And the big news of the week was in his first term as president, Donald Trump nominated to the Fed Chris Waller and Judy Shelton. And then we talked about how that contrarian nature or more dissenting nature, and this has been the year of Fed dissents, would be no bad thing.
I do applaud the effort to diversifying the
Yeah.
Fed's thinking, away from a more sort of groupthink way of analyzing markets where PhDs all go to the same school and all think the same way. So
Yeah.
to the extent that these are less in the conventional pool of nominees that one would select, I think that's worth commending.
Again, we've seen more dissents from the Fed than usual over the last year. Do you think that was the correct assessment on our part, that dissent is not a bad thing when it comes to the operations of the central bank?
Yeah, no, because I think one of the big risks of central banks, a couple risks I'll point out. One is just groupthink. To the extent that they all are educated in the same sort of thinking, I think it's good to have a diversity of opinion, people coming from different angles, so that you don't have groupthink. I know that even though generally when they make their decision, the dissents we've had recently are pretty unusual. They kind of come together, but still, one would hope that while they're talking about what they're going to do, that there's a pretty active debate. And there may possibly be one, but I would love to see different views of different opinions and not too much. I worry about the element of groupthink. More generally, this is going to shock you. I do not support independent central banks. I think that that has served its time, and over time they've become less independent. They've become enablers of the government, and they are, in my mind, a real affront to democracy. Yes, Congress effectively is a point of having granted the authority to have central banks, and they do come to Congress and give their sort of presentations, and congressmen are keen to impress everyone about how smart they are about central banking for a couple times a year. Two things I would or make me really against the independent central bank at this point is, first of all, they're not that independent. They are enablers, and secondly, it's just an affront to democracy. So I've come to the point in my view, and it's a big change. I was always a supporter of it. I don't really support it anymore.
What does reform of that look like? I mean, as you say, it seems as though you are arguing against independence because they're not that independent. So is it a question of somehow taking back independence, or is there a reform in the political process that you see as helpful in getting central banks to no longer be, in your words, enablers of government policy?
One thing that you could argue that sort of is a reason against what central banks do and how they've evolved is right now they seem to be very much followers.
Mm.
So if 2-year yields comes down a whole lot, suddenly they're cutting. If 2-year yields go up a whole lot, it's a kind of a cause and effect. The cause is the market and the effect is the central bank changing policy. So I'm not sure that are even really that needed. If inflation's going to fall a whole lot, they're going to cut. If it's going to go up a whole lot, they're going to hike. But you also get that through the market as well.
Mm.
Honestly, Tim, my view is not well formed, but I just don't think that they're serving a good purpose at this stage.
The other big topic, and here again, I'll play the clip, in early July 2019 was the nomination, speaking of central banks, of Christine Lagarde to be the head of the ECB. Let's listen to that.
So let's move on a minute, Tim. So
Yeah.
we got some some announcements this week. We have a new ECB head. What do you make of the announcement that Christine Lagarde is going to take over from Mario Draghi?
Policy-wise, I really love it, if only to avoid Jens Weidmann sitting in that chair for the next 8 years. I'm not certain if this is good for the euro, but I think it's very good for Europe, which probably in the long run is good for the euro.
I more or less agree with that, and I would just emphasize one other point. That she, like Powell's a lawyer, so we have two lawyers that are now running central banks, which is a certain change. But then you might actually need a lawyer to be able to help craft the rules in which that program can be expanded.
To be fair, this was probably more my opinion than yours. I think this was one where you threw the question back to me, and I suggested that she would be a good head for the ECB. I'm not so sure I got that right. You did agree with me. Would you admit that we both got this wrong, or do you think she has been a good head to the ECB?
I do think that she had a certain skill set that perhaps at the time was useful to the ECB. She came in as a politician and a lawyer. And look, it's a wieldy organization. I don't know how many different people vote, but it's a lot.
Yeah.
And, she probably has some sort of skills around consensus building. But I just don't think that the ECB has done a particularly good job. If we think about the Fed was being late, certainly they had a lot of criticism on their reaction post-pandemic to the inflation shock. I think the ECB perhaps is even worse. And also, I think the thing that many people will point to is, I guess the term is sort of expanding their mandate in places that maybe central banks shouldn't go, like the green transition and these kind of broader mandate things that really the Fed thought about but rejected and said, we're here to set rates and that's it. And even though I was critical of the Fed earlier, I think they got that sort of right. But I think overall, it was their slow inflation response and the politicization of the bank that would be my main criticism about her ECB headship.
Well, enough going down memory lane. Let's close things out with some current events. This is a big week for markets. We've had massive moves over the last 24, 36 hours of trading hours in dollar yen. The climb in gold continues. The dollar is under pressure yet again. I wanted to talk about each of those, but before we get to that, you've talked about the belief that the market is due a correction. It's a little bit overstretched. Valuations still matter. That's part of a consensus outlook that I would say is characterized as 2026 will just be a maybe lower volatility version of 2025. Beyond the equity market valuation story, are there any other consensus elements that you would push strongly back against?
I'm not sure how consensus or non-consensus this is, but historically we've seen a quite strong link between the dollar and the relative performance of US equities versus the rest of the world. I would push back and say that I do think the dollar is going to be lower, and that's probably going to come with an underperformance of US equities versus the rest of the world. Is that consensus? I'm not sure, but that's sort of one thing I've been thinking about.
Well, I think it isn't consensus because I think the belief was, yes, the dollar might have another down year this year. And it's, when the dollar sells off, it sells off in multi-year trends often, and it's still overvalued. But the belief was that equities would be fine and that you might just get, well, our belief is that you'll get more hedging of US equities. But the belief that both equities and the dollar would go down, I don't think is very consensus at all, especially on the equity side.
Mm.
The down move in the dollar has come, especially in recent days, with just this relentless rise in precious metals. I mean, especially silver, but that's a less liquid market. Let's focus on gold because there is this view that gold is now the last safe haven standing. I mean, you have your days of performance in the Swiss franc. We'll talk a little bit about the yen in a second, but it really is gold that is standing out here. As contrarian as you are, do you think that move is also overdone?
Tim, I've got to say, one of the most funny things in the world is this idea. And I understand kind of where it comes from, but we hear about the debasement trade a lot and how gold is a beneficiary of that. But in a debasement trade, why are treasury yields not so much higher, right? Why is the dollar not, so much lower if that is really what's going on? It feels like gold is becoming somewhat of a mania at this point. I was looking at the monthly RSI just as we started talking about this, and it's up to
Yeah.
95.2. I don't know what it got to in the late 70s. In 73, apparently it got to a similar level, and at the peak in 1980 was actually almost the same as well, 94. So I don't know. It feels like it's in the late stages of a blow off top. I certainly would be very, very scared to take a position either way, but maybe I would be interested in looking for the it to reverse at some point. It does seem a bit crazy. I think it's more a gold mania trade than anything else.
Yeah, interesting. It's a small market still, as we are reminded time and again, and flows do matter, and a lot of flows in a small market that can have that effect. Last question, and this brings us full circle, I think, a little bit talking about the yen. This was another consensus long. In fact, I think it was maybe you agreeing with the consensus that it would be a long for this year. We've seen over the last, again, 2 trading sessions or so, but also over the last week, there's been a lot of volatility in JGBs, a lot of movement in the yen in response to it, as well as rumors of rate checking and perhaps intervention. Is this what
Mm.
finally gets the dollar yen trade to come good, Fred? Are we about to see your year ahead view play out?
Let me put on my Nostradamus hat, Tim. What I would say, which I think was quite interesting to observe, is that if you looked at, say, 10-year spreads between JGBs and the US and dollar yen, it tracked pretty well. It was a good tracking mechanism until recently. And what it says is it's a really scary situation when you add up growth, inflation, bond yields, and the yen, and you think, okay, if you're not willing to put rates up and do something to stabilize your bond market, the debasement of yen can continue unabated. So they're between a rock and a hard place there. And it seems like you've hit the crunch time. So I think that once they come to the table and start putting rates up sufficiently, you are going to see the yen recover. Largely, it's the yen has tended to oscillate with treasury yields more than JGB yields, so there is that issue. But the bottom line for me is it's just so undervalued that eventually, to the extent that valuation matters, and here you go, my big weakness as a strategist, emphasizing valuation, I think there's a reasonable chance that this will be a good year for the yen.
It's good to know our weaknesses. It's also good to highlight our strengths, as you have done. And Fred, it's been great to do this with you. Hopefully, it's certainly not going to be the last time we speak. But thank you so much for all the stuff you've done over the years and the thought-provoking research and the ability to challenge conventional wisdom in the very witty but well-hearted way that you do.
Tim, you're too kind. Thanks a lot for giving me the opportunity. Really appreciate it.
Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time. For informational purposes only. It is not intended to suggest or recommend any transaction, investment, or investment strategy. It does not constitute investment research, nor does it purport to be comprehensive or intended to replace the exercise of an investor's own careful, independent review and judgment regarding any investment decision. This communication and the information herein does not constitute investment, legal, or tax advice, and is not a solicitation to buy or sell securities or any financial instrument, nor is it intended to constitute a binding contractual arrangement or commitment by State Street of any kind. The information provided does not take into account any particular investment objectives, strategies, investment horizon, or tax status. The views expressed herein are the views of State Street as of the date specified and are subject to change without notice based on market and other conditions. The information provided herein has been obtained from sources believed to be reliable at the time of publication. Nonetheless, we make no representations or assurances that the information is complete or accurate, and you should not place any reliance on said information. State Street hereby disclaims any warranty and all liability, whether arising in contract, tort, or otherwise, for any losses, liabilities, damages, expenses, or costs, either direct, indirect, consequential, special, or punitive, arising from or in connection with any use of this communication and/or the information herein. State Street or its affiliates may from time to time as principal or agent for its own account or for those of its clients have positions in and/or actively trade in financial instruments or other products identical to or economically related to those discussed in this communication. State Street may have a commercial relationship with issuers of financial instruments or other products discussed in this communication. This communication may contain information deemed to be forward-looking statements. These statements are based on assumptions, analyses, and expectations of State Street in light of its experience and perception of historical trends, current conditions, expected future developments, and other factors it believes appropriate under the circumstances. All information is subject to change without notice. This communication or any portion hereof may not be redistributed without the prior written consent of State Street. Past performance is no guarantee of future results.